but 3 guest speakers at a time. And we are really fortunate and privileged to have all these 3 speakers for today's forum. The session is going to be a full of learning and knowledge, I'm sure. So our first speaker is Mr. Vetri Subramaniam, who is a Chief Investment Officer at UTI Asset Management Company Limited. He joined UTI AMC as Head Equity in January 2017 and assumed the role of Chief Investment Officer from 2021. Vetri has over 3 years of work experience. Prior to joining UTI, he was
3
Chief
decades.
Investment Officer at Invesco Asset Management Limited. He was part of the startup team at Invesco in 2008 and helped establish the firm's proprietary investment process and the team. Vetri started his career at Kotak Mahindra in 1992. After passing out from IIM Bangalore and PG Diploma in Management, his experience in equity market and investment role at various firms from 1994 includes Kotak Mahindra, SSKI, and Motilal Oswal. He was also one of the founder of ShareKhan.com, where he led the research and content team. He also worked as an advisor to the UK Hedge and Boyer Allen on its equity investment in India during 2003 and till 2007. He is a frequent contributor to the media and regularly speaks on investing and markets at various forums, including the media and educational institutions. So we are really fortunate to have you here, Vetri Subramaniam, on this platform. So let's see the insights about the market. Thank you, and over to you, Vetri.
Uh, Thank you so much, Disha, Anjanea, for organizing this, and thank you everybody who's logged into this or is listening to this. Delight to be able to address all of you today. Now, when there's such a long and elaborate, sort of introduction, the one thing that becomes very evident to me, if it hasn't become evident to you, is that I've been around a very, very long time. Literally 30 plus years of work experience and 30 years in the markets. And if there's one piece of advice I'd want to give you about investing, it is essentially this, which is that when most of us think about investing and you think about the equation of compounding your wealth, most people tend to focus on the R, right? So in the compounding equation, there is the R, which is the rate of return, and N, which is the number of years. And most people tend to focus on R because that is the sexy part of the equation. But if there's one thing I would want to leave with you and something I want you to mull over, is that the most important part in the compounding equation is actually N. And the reason I'm standing here in front of you today is a tribute to the N, which is just being in the markets and being there for 30 plus years and taking the ups and downs and tumbles of the market gives you the benefit of compounding wealth over very, very long periods of time. And that is really the objective with which anybody should think about wealth creation. Always remember, in the compounding equation, it is the N which will determine your final outcome. R is very nice to have conversations about, but it's really the N which is the much bigger determinant. So without any further ado, what I'll do is jump into my section for today. As Disha said, there are 3 of us, so I'll cover more of the big picture, sort of macro, and then hand over to Ajay Tyagi, who's our fund manager and head of equity. He manages the UTI Felxicap fund. And then after that, Sharvan Goel, who's the head of passive and also quant at UTI. He will then discuss the UTI multi-asset strategy, which he manages. So let me just pull up this deck on the screen. Hopefully this is now visible to you. I'm not going to run through this. This is a fairly elaborate deck, but I just wanted to highlight, 2 or 3 key slides out of this 20-page deck. It's a standard deck that we do every month, but I just thought I'd, touch on some things which I thought were of interest. So the first slide you see over here is really about the economic forecast, and just look at that column for FY25 estimate. Today we just had RBI come out and say that they are cutting their estimate for GDP growth for financial 25. It used to be above 7%, 7.2%, but they're actually now cutting that down to 6.6. The number you see here is the Bloomberg consensus. Even as of 4 weeks ago, it was at 6.9% consensus estimate. I've not updated it for the quarterly numbers which came out for GDP of the second quarter last week. And I think by the time that number came out, the professional forecasters, as Bloomberg calls them, had already cut their estimate down to below 6.5%. So I would say, in a way, it's actually RBI which is playing catch up. The professional forecasts were not expecting 7 plus. And again, the GDP number which came out for the second quarter at 5.4% should not be a big surprise, because even before the GDP number came, we had commentary from companies. We had already seen the quarterly earnings for many companies, and that itself was telling us that there was some kind of a slowdown in the economy. So I think that number comes down to 6.5% or slightly lower than that. That's my sense. Again, if you look at it in the context of history, I would just submit that 6.5% is pretty much, sort of the level of where India is capable of achieving. And then the balance plus or minus 1% is a function of cyclicality. But if you think about India from a structural perspective, then I think the 6.5% is a very good base number to work with. And then depending on whether the global cycle is favorable, the industrial cycle is favorable, you could see 100 basis points higher or 100 points lower. Most interesting thing in this chart, other than that, I would actually say, is the phenomenal thing that India is managing to do when it comes to the fiscal deficit. At peak, the fiscal deficit had gone up to almost 9% in 2021 during the fiscal deficit spiking up because of the pandemic, but that is now on course to drop to most probably 4.5% in FY26. So that's a very dramatic compression that's happening on the fiscal deficit side, and that's something that I think ensures India's macroeconomic stability. But let's just jump through now quickly to, I won't go through this high frequency indicators. We'll just jump through straight away to the earnings picture. There have been some more cuts to this. This was the Bloomberg consensus number as of 3 weeks ago. 9% earnings growth estimated for FY25, 14% earnings growth expected in FY26. I think both these numbers have seen a further 1 to 2% cut. So you're talking about something more like 7% now for FY25 and about 12 to 13% for FY26. So people have started to factor in the slowdown into their numbers. What does this imply in terms of valuation? Again, let me just jump through to the valuation slide. What you see on this slide is the Nifty trailing PE multiple on the left-hand side and the forward PE on the right-hand side. Now, the yellow line is the long-term average. The white area is, so to speak, the sort of what you could call the fairly valued zone. And then the red is where the market gets expensive. Green is where the market gets quite cheap. If you look at trailing earnings, we are in the fair value zone. But if you look at the forward earnings, we are actually in the expensive zone. But actually, this is as of November 8th, which was a month back. So if you go back about 2 weeks when the Nifty was at its lowest point, it had actually dropped from the red zone and was just about to enter that white zone. So I would say the Nifty is not cheap, but neither is it nosebleed expensive. It's richly valued, but nothing extraordinary. The two components of the market which give me a lot more discomfort in terms of valuation are the mid and small caps. But first, I'll just show you the price to book for the Nifty. Now, return on equity in India is at pretty much the highest level in almost a decade. In line with that, the price to book is also pretty much the highest we've seen in a decade. So you could say there is a relationship between these two. But what's important to remember is that most things are cyclical, and therefore at some time you will start to see this ROE come down. The other reason the ROE will come down is that if India corporate India invests very aggressively, it's great for the future of earnings growth, but in the short time, it depresses ROE. So this price to book multiple at 3.66, this was again a month ago. At the low point, it had dropped slightly below 3.6 into the white territory, is again rich but not super expensive. What is super expensive is on the next slide, which is on the left hand side, you have the mid caps, on the right side, you have the small caps. This is where valuations are, very aggressive. And remember, we are not talking about one company or two companies. We are talking about the aggregate for 150 mid cap companies, the aggregate for 250 small cap companies, and comparing it to the aggregate for 50 companies. To see the smallest companies, these small 250 companies trading at a premium to the Nifty, which is at about 3.6 times, this is pretty much the first time I'm experiencing this in my 30-year career. It's happened quite often in the mid caps, and I would say the mid caps very often trade at a premium to large caps. And then at the worst point in the cycle, they come to a discount. These small caps historically have always been at a discount. It's the first time they've gone to a premium, and that does cause some concern. Uh, there is a reason why small caps, at least theoretically, should get a slight discount. One, these are companies which have challenges in terms of access to capital through the economic cycle. Today they've got access, but at more difficult parts of the economic cycle, typically their access to capital gets limited or is constrained. They tend to get affected a lot more by economic cycles also because of regulation changes, because their bargaining power relative to larger companies is limited. Typically they tend to be in the weaker side of the equation because they're supplying to a bigger company or they're buying from a larger company. So there is a reason why typically small caps, when you look at their data in terms of ROEs, earnings growth, have tended to be more cycle. There are parts of the cycle where they do very well, but there are parts of the economic cycle where they tend to do poorly. And that's why I would say on average, seeing them trading at this kind of a premium to the large caps creates a little bit of discomfort. But this is as far as valuations are concerned. Large caps, rich but not super expensive. Mid caps, small caps from a valuation perspective, certainly giving some cause for discomfort. Let me just run you through now quickly to, just sort of encapsulating some of our, top-down thoughts on the markets. So, as far as U.S. Federal Reserve policy is concerned, they've obviously got a meeting coming up this month. I think there's still fair bit of uncertainty about whether there will be a rate cut. And just given the strength of their economy, which is still growing at 3% and above, and inflation, which has come down from its peak, but remember, their target is 2%. Even today, inflation is at 2.8%. So I think their ability to cut rates is getting constrained, also because their growth is so good. So how do you cut in that kind of environment? And the other challenge is that their fiscal deficit is still very elevated. It's actually running at 6% of GDP and no signs of it coming down. And therefore, that long bond yield, the 10-year bond yield, is proving to be very, very sticky. The dollar has strengthened significantly in response to this because growth is faster. The outlook for rate cuts is slightly more muted. The expectation that the US, with the new incoming administration, may implement tariffs has all caused the US currency to be stronger, and their growth differential vis-a-vis particularly the developed economies is in their favor, and that's why their currency has been much stronger, particularly since the election result exactly a month ago. In India, I think what's important to remember is that our policy settings have been very conservative. As I said earlier, fiscal deficit from 9% peak coming down to 4.5%. You don't see this pattern in many parts of the world. There are very few countries which have been so fiscally conservative. Similarly, on the monetary policy side, the policy stance was reduction of accommodation till the last policy. Only last policy they changed it to neutral, and this policy we finally saw some movement, at least on CRR jet liquidity, though they're still not willing to cut rates given the focus on 4% inflation. But I do think over the course of the next 6 to 12 months, the scope for about 75 basis points of policy rate cuts in India remains good based on the current trajectory that we see for growth and for inflation. Earnings growth, we already talked about 9% and 14%. But as I said, in the last 3 weeks, we've seen further 2% cuts to those numbers. Some discomfort over where mid caps and small caps are trading. So, what does one really do in this kind of an environment? Our perspective is that focus on asset allocation, focus on risk management. There are markets in which you should be greedy for returns, but there are markets in which you should worry more about the risk that you're taking on in an attempt to create return. This is that kind of an environment where you've got these super elevated valuations, and then you're looking at it in the context of an economy which is showing some cyclical weakness. Asset allocation, we think, is a good way to tackle this in the current environment, and that is why hybrid funds are something that we feel quite positive about. And of course, Sharwan is going to be talking to you about multi-asset, which sits in that hybrid category. The other reason we like the hybrid category is that you will earn a positive carry from the fixed income component of that portfolio, but it's being earned in a structure of what is primarily an equity fund. So you get the benefit of the carry in a very so to speak, tax efficient manner. Uh, what about, investing style? Value has done extremely well over the last 3 years. We think this is a good time for an inflection in favor of quality growth. And finally, if you're doing an SIP, it doesn't really matter because you'll invest through different parts of the valuation cycle. But yes, our focus would be rather than do lump sum, invest in a staggered fashion, and the bias is towards large caps. So that's sort of my big summary of what I'm seeing in the markets at this point of time. I'll halt over here, Disha, and we can take any questions on the macro section. Anything to do with markets, economy, fixed income, I'm happy to take that. And then we can, sort of switch back to Ajay, who'll talk about Flexicap, which, is really in that quality growth bucket that I talked.
Sure. Thank you so much, Vetri, for this apt and precise presentation. I'm sure everybody must have got their takeaways about the market. So I have received few questions which I would like to display on the screen. Just give me a moment. Yeah, so I'll just read out for everybody's convenience. So my first question to you is, how do you see global macroeconomic trends such as the US rate policy and China economic slowdown impacting the Indian market in near terms?
It's a good question, Disha, but, if I were to just step back for a moment, see, I think in a very long journey of 5 years, 20 years, 30 years, what did I say at the beginning? Think more in terms of N, which is the number of years, rather than R, which is the rate of return. So when you think about very long term, these factors that you're mentioning here will not change my basic view. 6.5% GDP growth is something India can manage, and very few large countries in the world, in fact, no large country in the world is managing that in this current environment. These factors that we talk about, federal rate, interest rate policy, China slowdown, those are all like changing the temperature by, zero point 0.5 degrees, 1 degree. It doesn't change the temperature of your AC by 5 degrees, this direction or that direction. It's like a zero point 0.5 degree change in the temperature. So I don't worry so much about it. Fact of the matter is, the US is proving to be exceptionally strong in terms of economic growth. At the beginning of 2023, most of the conversations were, when will US hit a recession? It is now 24 months since we started discussing that, and there is no sign of a recession. In fact, it is still growing at 2.5 to 3% per annum. And remember, that's a $30 trillion economy, meaning they are adding 1 trillion to GDP every year, right? So that's unbelievable. So I would basically say the Fed does not look like it is in a hurry to cut rates. A, inflation has not reached target. B, growth is still reasonably robust. So it will come down. I think the scope for them to cut rates, if you ask me, over the period of a year to year and a half, is more than the potential in India, simply because their inflation rate is much, much lower compared to our target. But in the short term, the fact is, all parts of the world are struggling for growth, particularly China and Europe are both really struggling for growth. It's only the US. India, as I said, 6.5% GDP growth. If the rest of the world is doing well, we can accelerate to 7.5%. If the rest of the world is doing poorly, it can have a 50 basis point impact on our growth. That's the way to think about it when you think about a 5 to 10 year cycle. The main thing that I want to say is that for India, achieve its aspirational growth number. The aspirational growth number is not 6 to 6.5%. The aspirational rate is 8%. To get to 8%, it is better for India that the whole world is growing well, because that is when you will be able to accelerate, rather than being an environment where different parts of the world are struggling for growth and there are only one or two bright spots. So eventually, if you ask me for our aspirational growth rate of 8%, what is important? We actually need the whole world to do well. Because if the whole world is doing well, we will be able to build on that and go much faster than what we are doing currently.
Yes. Thank you. Thank you so much for the precise answer. Moving to my next question. Which sectors do you believe are the most positioned to outperform in 2024, considering current economic conditions and government policies?
Disha, as I said, I've been doing this for 30 years. I started my career, I thought I knew what will perform best every month, every quarter, maybe even every week. But very quickly the market slapped me 2, 3 times, and then I realized these are not possible to know beforehand as to what will do well. Kabhi kabhi you get lucky and it works out. So really, the way I think about this is that where is the best opportunity? और opportunity आपको कहाँ पे मिलता है? आपको वहाँ मिलता है जहाँ the businesses are fundamentally well placed and where the valuations are attractive. Because when you get the combination of good fundamentals with cheap valuations, all you have to do is get there and sit there. It may not be the best performing sector for the next 1 month, 3 months, 6 months, or sometimes even maybe 1 year. But if your entry point is right, and if your thought process in terms of what can happen positively is correct, then over the medium to long term, again I'm talking about N rather than R, that is where you will make the best money. So my answer about which is my favorite sector has not changed for the last 6 months. I think banking and financial services and the big banks are the best, not because their stock prices are doing the best. In fact, their stock prices are not doing the best. But their fundamentals and valuations are so attractive that this is where I can see a great opportunity to make money over the next 2 to 3 years.
Yes, thank you. Thank you for guiding all of us. Moving to my last question. Indian equities are trading at relatively high valuations compared to their global peer. Do you think this is justified or should investors brace for correction?
So just 2, 3 points to make here. See, the first point is that Indian investors, due to multiplicity of reasons, are only investing in India. So it is only the global investors, the institutional investors who are looking at valuations in India, comparing it to the other parts of the world and saying, where is my best opportunity? And I think that has resulted in the flows to India from global investors being negative year to date and not very aggressive for almost the last 1.5 years. Why? Because when they look around the world, they feel they are getting better opportunities in terms of वो भाव के लिए क्या मिल रहा है. They are finding better opportunities elsewhere. So they are preferring to go there. If India's valuations become cheaper, my sense is you will see a lot more foreign money actually come, because for them it is a question of इस भाव पे क्या अच्छा लग रहा है मुझे. So I think from a foreign perspective, the expensiveness of India is certainly a little bit of a roadblock in terms of flows. And when a market is richly valued, my experience is that what it means is that you have actually eaten into your future returns. So your past returns, when you look at my mutual fund statement or my mutual fund fact sheet, will say last 5 year returns 20%, 18%. But that doesn't mean the future returns will be 20%. And when a market is richly valued on the back of very strong returns, it means sometimes you have borrowed the returns from the future. So I don't know when a correction will come. Maybe you will not get a price correction, you will get a time correction. But yes, if my base expectation is equities is the 12 to 14% asset class, today my expectation from equities is much, much lower than that. So Sharvan will talk more about this later, but in our multi-asset fund, we allocate to equities based on our experience of at this kind of valuation, what kind of return can we expect from equities. And today that model is not very positive, which is why our equity allocation is only about 52%. The lowest we could be is 40, highest can be 80, but we are only at 52. And the reason we are at 52 is that we think we have borrowed some of the future returns, and that's why we are preferring to not be more heavily exposed to it.
Yes, thank you. Thank you, Vetri, so much once again. And we are really fortunate and privileged to have you here on this platform with us. I'm sure all our partners have got a good insights about this presentation. And thank you once again. So, yes, moving to our next guest
Yeah,
speaker,
Disha, before
Ajay. Yeah,
before
yeah,
like,
yeah,
I would
sorry.
like to say thanks to Vetri sir once again. It's a really a privilege having Vetri sir on the call. We have seen him on different forums and speaking many times and things. So it's first time that Vetri sir is there on our call, our partners call, and I'm sure the insights and like very crisp, very pointed views as we generally look for as the answers. This is something which we are getting here. I truly appreciate Vetri sir. Thanks for sparing time. I'm sure we'll have much more engagement in coming time soon.
Look
Appreciate
forward
it.
to that,
Thank you so
Anjali
much.
and Disha. Thank you.
Definitely, sir. Thanks.
Thank you. Thank you so much. So, yes, moving ahead with our next guest speaker, Ajay Tyagi, who is a head equity at UTI Asset Management, and he's a CFA chartered holder from the CFA Institute, USA, and also holds a master degree in finance from Delhi University. Ajay joined UTI in year 2000 and has successfully carried out various roles and responsibilities across equity research, offshore fund as well as domestic onshore funds. He has won many awards and accolades for his performance both domestically and globally. Ajay presently manages our flagship equity scheme in India and is also an investment advisor to UTI International range of Indian dedicated offshore funds. So yes, over to you, Mr. Ajay Tyagi. Thank you, and we are fortunate to have you here on this platform. Thank you.
Yeah, thank you very much. Thanks for getting UTI onto this platform. Since I will be discussing the UTI Flexicap fund, let me share a few details about the fund before we go ahead and discuss the fund in detail. So, this is how we describe the philosophy of UTI FlexiCap. It is built around these three key pillars, which we call as quality, growth, and valuation, and essentially in this order. So, the most important thing for us is to ascertain whether the companies where we are building exposure are high quality or not. So, uh, I mean, just to define quality for everyone on this call, we feel businesses which have high return on capital, which have a strong balance sheet, which have strong cash flows, are the ones which qualify as high quality. Businesses which actually do not possess either strong cash flows or maybe have a very patchy track record, or maybe during certain times or certain points of time in the cycle are doing well, but certain other times are struggling in terms of value creation, in terms of steadiness in margins, steadiness in cash flows, are the ones which we don't like because they aren't indeed high quality. So quality really is about very, very steady outcomes, regardless of whatever is the market cycle. Economies can go through their own ups and downs. Economies can go through periods of high growth, periods of slow growth. But regardless of this external environment, if a business is able to show very strong, predictable, steady outcomes, then they are indeed high quality businesses. And our objective is to remain invested in such businesses alone. The second thing that we look at after we have looked at quality is basically companies which are growing significantly faster than the overall markets in general in terms of their earnings growth. So we all are aware that if we look at the last 10 years or even 20 years in terms of earnings growth profile for the Indian markets, the number comes to somewhere around 12 to 13%. We like owning companies which are delivering at least 16-17% kind of growth. So mid to high teens is the kind of growth that we expect from our portfolio as a whole. There could be certain companies growing at the lower end of this, just like there would be a few companies growing at the higher end of this, but the portfolio on the whole should grow in mid to high teens, by which I mean at least let's say uh, between 16 to 18%. So that should be the broad range. The last part is valuation. And essentially, I must say, before I describe valuation in detail from our perspective, I should say that the sequence that we follow is quality first, then growth, and then valuation. We never get excited by cheap valuations, and we never, look at companies which essentially are cheap and can, be candidates for re-rating unless until they actually have the quality and the growth attribute in place. So valuation alone will never excite us, no matter how cheap the company is, how cheap the stock of the company is. But valuation is important for us only from the perspective that we shouldn't end up overpaying and overpaying grossly. That's the only objective of valuation exercise for us, rather than trying to figure out whether something is cheap relative to its intrinsic value, which a typical value manager always looks at. So from that perspective, we feel that companies should be looked at in terms of their own historical bands rather than being compared to other companies in the sector. So an HDFC bank will always look expensive in the context of the Indian banks. A Punjab National Bank or a Bank of Baroda will always look cheap in comparison to the overall banking universe in India. And there is no point comparing the two, because the two have very different sets of outcomes. So it's best to compare HDFC with its own long-term historical valuation band, and equally it's important to compare PNB or above to their own valuation band. So that's point number one. Point number two, most high quality, high growth companies have a very long runway of compounding. So they keep growing for very many years, sometimes even decades together. Therefore, relative valuation just from a 1 year forward perspective or 2 year forward perspective may not make sense. It is important to value these companies from a discounted cash flow perspective, which takes into account their next 10 years and 20 years of growth. So that's the other point. So that's how we look at valuation. If I move ahead, a few other points that I wish to make about our philosophy is that we are not driven as much by macroeconomics, but we are driven more by microeconomics of businesses. So things like interest rate, inflation, and all of these things don't matter as much to us as would the demand supply scenario in the industry, the competitive scenario in the industry, whether it's a duopoly or an oligopoly, which means much less competition and therefore much more pricing power for companies, versus something like a perfect competition where there could be 10 different players and therefore pricing power can never be attained by any one player. So that's the kind of study that we do, which is understand the industry in detail, understand the competitive landscape, understand the entire ecosystem, and then try and build conviction around the business that we have zeroed in on. It is a strategy with very low turnover. Our annual portfolio turnover is between 10 to 15%. The other way to say the same number is that we like holding our companies for between 8 to 10 years. So we take time to invest because we do deep research before we gain conviction. Once we do that, then we hold on for a fairly long period of time. Quarterly disappointments, in fact, I would say disappointments even over a 1 or 2 year period, are never enough for us to go down on our conviction, so long as the overall business in terms of its medium to long term outcome remains strong. We would continue backing it up. But at the same time, while we have low portfolio turnover ratio, we have a very high active share, which basically means that we are very different from the benchmark. In fact, our active share is as high as 70%, which means that from a portfolio holding perspective, we are 70% different from the benchmark. And that is also happening because we have some very high overweight and underweight positions. What we don't like could just be zero in our portfolio. What we like can be significantly higher than the weight of that company or for that sector in the benchmark. It's an all cap strategy. As we all know, Flexicap means that we have large, mid, and small. For us, again, this is not a way to swing in or swing out of any market cap bucket. That's not something that we do. But yes, for us, it enables us to pick the best businesses from any of the market cap buckets, large, mid, or small. So that's how we utilize the flexi nature of this category by not stopping ourselves from buying anything in the large cap bucket or the small cap bucket. The best business comes in regardless of whatever the market cap of that company is. So finally, coming into some numbers, like I mentioned to you, the fund actually has its growth rates in the mid to high teens. Let me start from the top here. The portfolio revenue growth is given as compared to BSE 100. And you can see here that our portfolio has about 3 to 4 percentage points higher growth compared to the benchmark. Operating profit again is 4 to 5%, in certain cases even higher compared to the benchmark across time periods, whether it's 3 years or it's 7 years or it's 10 years. Return on capital again significantly higher than the benchmark. Last but not the least is net debt to equity. And I would want to spend 30 seconds here. See, net debt to equity, when it is negative, it signifies that the company has cash rather than debt. A negative number here means net cash holding on the balance sheet rather than debt. And this is the hallmark of a very strong, high quality business which is generating strong cash flows, therefore does not require any debt. So in a way, what this slide tells you is that while we are growing faster than the markets, we are also much more profitable than the market. Our businesses are much more profitable than the market, as showed in return on capital. And the balance sheet is the strongest because it's net cash compared to the benchmark, which is having debt to the extent of 0.54 debt equity ratio. And this just tells that we are not compromising on the quality attributes of companies while we are chasing growth. At the same time, very low standard deviation. You can see over all time periods, the standard deviation of the fund is lower than that of the benchmark. The beta of the fund approximately is between 0.8 to 0.9, which again shows that there is lower risk that we are taking. Yeah. So I think I would just pause here in the interest of time. There are a few more slides that I have. If there are any questions, I can answer those first, and then maybe if time permits, then I can take you through a few slides. Yeah.
Thank you. Thank you so much for the insightful presentation. So yes, we have received few of the questions. I would like to display it on the screen.
Yeah, Disha, while you're displaying the questions, I think the next slide, which I'm seeing on screen. Hi, Ajay, Anjane here. Thanks for joining in. I just intervened because the slide which is showing here is a very interesting topic, quality and value. Disha, once your questions are over, I'm very keen to listen to Ajay's view on these 2 pointers. I'm sure our partners would be really, really interested to know. This is a very interesting topic. So once we have time, I
maybe I can
look forward to it.
Okay, sure. So let's complete the question, then I can revert back to this.
Yeah, I think the questions are more centric to specific fund. So I think we can take the presentation. We can complete the presentation first, and then after we can take the questions if you want.
Okay, sure. Then let me just quickly run you through these few slides.
Yeah.
Quality versus value. So what you see on this slide is basically a comparison of these two broad indices representing these two factors, the quality factor and the value factor, going all the way back to 2005. And what we have done here is we have compared one versus the other to see which are the time periods when quality has done well and which are the time periods when value has done well. So the blue shaded areas are the phases of quality.
Ajay, your slide is not visible.
Slide, yeah.
Is it visible now?
Not yet.
No, not yet.
Okay.
Yes.
Yeah, now it's visible.
Okay.
Thank you.
Okay. So I was saying that what we have tried to capture on this slide, going all the way back to 2005, is the relative performance of the quality factor versus the value factor. And each of these factors are measured by the Nifty indices, Nifty Quality Index and Nifty Value Index. Now, and this comparison is on a 1 year basis. So every point here is basically the 1 year returns of quality minus the 1 year return of value. Whenever we see the blue shaded area, you should consider these to be phases of quality outperforming value. Whenever you see the yellow shaded areas, these are basically value outperforming quality. Interestingly, what you see is that this rotation keeps happening every few years. But what we have witnessed in the Indian markets in the last 4 years is something which we have not seen over a 20-year period, which is an extremely prolonged phase of value outperformance. If you very carefully see on the extreme right of this chart, you see a blue pattern emerging back again. This is because over the last 6 months, value has underperformed quality. We have started seeing a reversal, but the chart also tells you that the value rally has been extremely forceful and strong, both in terms of the time period as well as the magnitude. So it hasn't ever gone on for 4 years. If you look at this chart, equally in terms of magnitude, it has never been such a massive outperformance ever in the past. What you see here on this chart is the same quality versus value alpha generation, but this time we are taking 3-year rolling returns. So each data point here is on a 3-year basis, the difference between quality versus value, with the blue shaded area showing quality outperformance, yellow shaded area showing value outperformance. Once again, you see a very big magnitude of outperformance by value even on a 3-year basis. Now, let me tell you about trend reversal. So we've seen the history. So we all are aware that growth funds and quality funds in India have not done well. The next obvious question is this about to change? And if yes, then what are the data points that are suggesting us the same thing? So here again, what we have done is we have taken the quality index and the value index. We have plotted, first of all, the blue line. And just for simplicity, I should tell you that whenever the blue line touches the top, it signifies a phase of quality outperformance. And I would say not just outperformance, but significant outperformance. Whenever the blue line touches the bottom, that's the phase of a significant quality underperformance. Now, whenever these time periods happen, which is either the blue line touching the top or the blue line touching the bottom, it signifies an extreme event in the marketplace. If you very carefully see on the y-axis, left-hand side, we have a number 0 written there. This 0 basically is signifying zero outperformance or underperformance between these two styles. So in a way, when you are at 0, when the blue line is at 0, quality and value are almost giving the same return. When you touch the top, that basically signifies a massive outperformance of the quality factor. And when the blue line touches the bottom, it signifies massive underperformance of the quality factor. Let me now introduce the orange line on this chart. The orange line is an interesting one because it tells the behavior of quality versus value on a next 1-year basis. At whatever point you are, orange line will tell you next 1-year returns. So suppose you are in May 2017. Because the blue line is touching the bottom, you are witnessing a phase where quality is significantly underperforming. But if you hold on to your quality portfolio, over the next 1 year, you can see that the orange line at the top is signifying a 40% outperformance of quality versus value. So in a way, whenever the blue line touches either the top or the bottom, it signifies a reversal. Suppose you are in November 2020, the blue line is touching the top. It is a phase of quality outperforming value significantly, but holding on to quality over the next 1 year meant that quality underperformed significantly the value factor. So uh, because we have seen the blue line at the bottom for the last almost 2 years, we know for a fact that we reached a phase of extreme. Whenever markets reach a phase of extreme, reversion starts. We also call it the mean reversion. The mean reversion has already started. As you can see, the blue line has meaningfully moved up in the last 4 or 5 months. I'll also show you some more data which shows that value has started underperforming. And as this trend reverses, we would see over the next few years a outperformance of the quality factor versus the value factor. At least the data itself is suggesting that reversal has started to happen, and you should see a exact opposite of what happened in the last 2-3 years. Now, this chart here is very similar to the previous chart that I showed you, except that the orange line is being replaced by the red line, and the red line signifies not just the next 1 year forward returns, but the next 3 year forward returns. And why we have put this red line here is to show you that whenever a reversal happens, it doesn't last for 6 months or 1 year or 18 months. The reversal typically goes on for a few years. And that is what is showcased here in this slide. Let me give the same example like I gave in the previous slide. Suppose you are in May 2017. You see that quality has massively underperformed value, and that's the reason why the blue line is touching the bottom. But if you hold on to quality, then over the next 3 years, quality actually outperforms value by 30%. CAGR, which means 30% every year. So that's the kind of mean reversion that typically happens on either side. I'm not saying just one side, but on either side, we are now, to our mind, about to see a similar mean reversion. Now, the last slide which I want to cover on this topic before I hand it back to you is, the obvious question is, which is the environment when quality does well and which is the environment when value does well? Now, I'll try and keep it as simple as possible, but if you still, find my explanation to be confusing, please stop me and ask me again. What we have done is we have captured data from 2005 to till date, 30th November 2024. We have broken up this data into 1 year rolling returns, 3 year rolling returns, and 5 year rolling returns. So each day we find 1 year return, 3 year return, and 5 year returns for Nifty 500, the broad benchmark, then quality 30 index, and then value 50 index. So quality factor, value factor, and the broad market. We are finding 1 year, 3 year, and 5 year rolling returns. 3 and 5 years are annualized returns. 1 year is absolute, of course, for each of these three indices. While we do this, we look at the results and then we say, okay, let's draw broad buckets, returns greater than 20%, returns between 10 to 20% per annum, returns between 0 to 10%, and then minus 10 to 0%, and so on. So these are the broad buckets that we have created. When does the value factor do well? Whenever the markets are bullish, whenever the markets are giving you a very high return. Obviously, we all know longer term return from the Indian markets is between 13 to 15%. There are times when the markets give you less than 10%. There are times when markets can give you even 20%. We all know when markets are significantly higher than long-term return potential of India, it's certainly a bullish phase. We have been in such bullish phase for the last 3 years, almost 4 years, when markets have been giving very, very strong returns. These are the period when risk-taking increases in the marketplace, when investors come down the market cap curve, they also come down the quality curve. So investors are not happy holding high quality companies. They want companies which may be poor quality, but there is a chance of re-rating here. They don't like holding large caps. They like holding mid and small caps, very evident from the flows that we have seen over the last 2 years. These are the favorite time periods for the value style to do well. That's why you see at the bottom, whenever markets have given above 20% return, Whether it's 1 year, 3 year, or 5 year, value index has given significantly higher return. Other than this scenario, are scenarios when markets are giving healthy returns to moderate returns to slightly negative returns. In all of these phases, you would see that quality outperforms. Whenever the markets turn slightly cautious, very clearly quality outperforms and outperforms significantly. So the other interpretation of this in this quality versus value debate is that whenever markets become a little cautious, you would see people wanting to reduce risk, invest into much more predictable and strong businesses, go up the market cap curve, come out of small caps, invest more into large caps. We think we are already in this phase, which will last for maybe a couple of years at least. So this is the other way to define when would value do well versus when would quality do well. So again, I'll pause here. I think I've given enough data points around this quality versus value debate. Yeah.
Yeah, thank you so much for the brief presentation. I'm sure it was really nice interacting with you, and definitely uh, our audience must have taken their takeaways. So I would like to move on to the Q&A session. So it is quite specific to one scheme, one or two particular schemes, but I wish if you can answer for the same. So I'll just display it on the screen for everybody's convenience. Just give me.
Sure.
Yeah, so basically it's based on the UTI Flexicap fund. So how does the UTI Flexicap fund balance investment across large cap, mid cap, and small cap stocks to optimize return while managing risk?
So, we have a bottom up strategy. We don't, construct our portfolio to, have a prefixed kind of allocation to large, mid, or small. So my answer isn't that, to balance risk, we would have X percentage in large caps and only a smaller percentage in mid and small caps. Or I would also not say that if mid and small caps are looking expensive today, they are certainly expensive today, by the way. We are shifting away from mid and small caps. So, our approach is more business like. Our approach is, um, which are the businesses which can create and compound value over the next 5 years. Whether they are coming from large, mid, and small, it doesn't matter to us. We don't look at overall valuation in small caps being high, therefore their allocation should go low. That's not how we think. Our focus is on selecting the right kind of business and then holding it on for fairly long. So that's how we look at our risk management. A strong business will essentially provide the best outcomes in terms of risk mitigation, regardless of whether it's large, mid, or small. Yeah.
Thank you, Sam. Thank you so much for the precise answer. So moving to my next question, again, it is centric to one scheme. So uh, in the current market environment, which market cap segment does the UTI FlexiCap have a higher allocation to, and why? What is the reason behind it?
I would say as of today, the higher allocation is to large caps. And typically, if you look at how we have been running this fund, the large cap allocation has been the highest, between 60 to 70%. It is around 60% even today. And again, this is the answer to this is linked to the answer to your previous question, which is that, see, it's the selection of the right businesses that finally goes as an outcome in terms of large, mid, small allocation. So we don't have a prefixed number in our mind, but yes, we have prefixed characteristics that we want in the companies that we wish to hold. That basically decides what the final number would be. Yeah.
Yeah. So that's it. This was the questions which I have received from our partners. So thank you once again for sparing your time today evening. And this
Disha,
was really a
Disha, can
wonderful.
I, if your time permits, can
Please,
I
sir.
just
Please,
ask
please.
one question? Ajay, I actually attended one of your session live in like face to face almost 6, 7 years back, 17, 18. And that time you gave a very good insight on the pharma sector, and you actually gave us insights into as to how pharma is structured into three different parts: healthcare, medicine, and R&D side of it. And that has actually played well. I mean, we all have seen over the years, thanks to COVID also, that also added impetus. What's if in a smaller time span, whatever Disha is allowing us, if you can just throw some light on that part, what do you see on the pharma healthcare space? That would be really great help. Thanks.
Sure. Sure, Anjane. So I think it has slightly expanded a bit. If we call the overall opportunity set as healthcare, then within healthcare, the segments which are panning out in terms of opportunities are as follows. In 2018, hospitals wasn't a very big segment, but it has emerged as a very, very big segment now. We have clearly more than half a dozen big hospitals that have IPO'd in the marketplace. So that clearly is the big opportunity. And let me also tell you, if you break up healthcare in India, hospitals are the biggest segment in healthcare by revenues and by profit pool as well. Obviously, when somebody becomes sick or goes ill, uh, the amount of money that we end up spending at the hospital is much more than what we would spend on our medication, and that is why this is the biggest profit pool. We are excited about this. I think the government has clearly decided that they are unable to run hospitals as efficiently as the private sector. It also requires a huge amount of capex and huge amount of talent. So they are happy the private sector taking this lead. The second one, which also was not present in 2018, although it's a much smaller segment, is diagnostics. We just had one company in diagnostics back then. Now we have at least 4 or 5 listed players. It is also emerging as a big opportunity. All of us are getting ourselves tested regularly. What is also known as wellness treatment, rather than getting our checkups only when we are ill. Uh, the third segment is you mentioned it yourself, pharmaceuticals. This is the second largest segment in the economy after hospitals, has been going strong. Within this segment, we are more comfortable with domestic formulation rather than generic opportunities or export opportunities to markets like US. The generic opportunities are much more volatile, much more commoditized. There is a massive, I would say, price deflation that happens in generics. As compared to that, the domestic formulations always see a massive price inflation. So you would see the typical drugs that the doctor prescribes to us. They keep increasing. The manufacturers keep increasing their prices by 4-5% every year. The reverse is true in US generics, where the price deflates by 4-5% every year. So clearly for us, domestic formulation is a much more lucrative opportunity. The last one is, the opportunity coming up on account of partnerships with global pharma. Think of companies like Divi's, think of companies like Syngene. They are partnering for either providing the active ingredient to global pharma companies or providing research to them. Research wasn't as big 5-7 years back, but it has now become very big. Companies like Syngene are partnering with global pharma at the very, very early stage for drug discovery. Within this segment, the cherry on the cake is what we call as the China plus one opportunity. The US has been clamping down on partnerships with Chinese companies, which means that more and more companies outside of China will get the opportunity to partner with global pharma and become their trustworthy partners, which would obviously increase business for them. So yeah, I mean, I would say broadly these are the segments, and to our mind, uh, the healthcare sector in general provides very strong, stable structural opportunity. I just want to caution everyone on this call that from a valuation perspective, healthcare is looking a tad bit expensive. Maybe there would be a cool off for some time, but the opportunities are clearly very strong and structural. Yeah.
Truly appreciate your views, Ajay. Thank you. Thank you so much. Disha, over to you, please. Yeah.
Yeah. Thank you. Thank you so much, Ajay, once again for this wonderful presentation. And thank you for sharing the insights with all of us. Thank you. Thank you for sparing time.
Thank you.
Yeah. So moving to our last guest, very important one, Mr. Sharvan Goyal, who is a fund manager at Head Passive Arbitrage and Quant Strategies at UTI AMC. He's a CFA chartered holder from CFA Institute USA and also holds a postgraduate degree in management from Wellinger Institute of Management, Mumbai. He has over 18 years of experience in risk management, equity research, portfolio analysis, and fund management at UTI AMC. So, yes, I would like to welcome Mr. Sharvan Goyal. Thank you.
Thank
Thank you
you.
so much. Yeah,
Thank you,
over
Disha.
to you.
Let me quickly share my presentation. Just let me know once it is visible. It is visible now?
Yeah, it is.
Yes,
Thanks.
So, yeah,
it's
thank you so much. Right. So let me quickly describe broad strategy that we follow in UTI multi-asset allocation fund. I understand that people are, in a sense, have joined this call for almost 1.5 hours. So I won't take much time. So UTI multi-asset allocation fund is a equity-oriented hybrid fund wherein all the time we are maintaining more than 65% gross equity allocation, although net equity allocation could be lower than 65%. So broad tenet of this particular fund is investing across 3 asset classes, which are equity, gold, and fixed income, and that too in a dynamic manner. So which means that allocation across equity, gold, and fixed income could keep on changing depending upon underlying philosophy that we follow. So let me broadly dwell on each strategy. So when it comes to equity, the net equity allocation range that we have decided is 40 to 80%. And the allocation across equity is dependent upon 4-factor financial model that we have tested for a very long period of time. So we have analyzed almost 35 factors which could have influence on future market return. But we found that these 4 factors, which are 1 year forward price to earning ratio, price to book value, dividend yield, and yield gap, financial model based on these 4 factors is giving us much better insight in terms of predicting next 1 year returns from broader trend perspective, because these 4 factors are having consistently high correlation with future market returns. Generally, we have seen that market keep reverting back to mean valuation, which means that whenever market valuations are expensive, generally future returns are lower, and whenever market valuations are extremely attractive, generally future market returns are higher. And broadly, we are using similar philosophy to decide equity allocation. Gold allocation varies from 10 to 25%, and it is dependent upon relative performance of gold vis-a-vis equity using gold to equity ratio. I'll discuss about this particular attributes in a subsequent slide. And residual allocation goes to fixed income, which is about 10 to 25%. First and foremost, if you look at this particular slide, wherein we have mentioned model equity weight in the yellow shaded area, while 1 year forward P ratio of Nifty is mentioned in the blue line graph. So let me just highlight a couple of data points here. So during COVID, when markets have corrected about 35%, so because of very sharp correction in the market, valuations became extremely attractive. So at peak of COVID, markets were trading at about 11 to 12 times 1 year forward P ratio. Extremely cheap as compared to longer term averages. And because of very cheap valuations, our model suggested increase in equity allocation from about 50% to all the way to 80%. So at peak of COVID, generally view in a sense, most of the people was negative, mainly because such kind of pandemic could impact your decision-making thought process as well, because near-term outlook was extremely benign. So people became extremely cautious on the market, and that's because markets have fallen. But a particular portfolio or fund which is looking to add value based on longer-term trend have suggested higher or increase in equity allocation to about 80%. Post-COVID, when we have seen that the recovery was also pretty sharp, market recovered within 6 to 12-month period, and from very low PE ratio expanded to about 20 to 23 times within 1 year period. So that's the time wherein models started suggesting lower equity allocation. And in last 2.5 years, equity allocation is varying between 45% to 65%. So just to summarize, this particular fund will suggest higher equity allocation whenever market valuations are attractive, and whenever markets are trading at expensive valuation, model will signal lower equity allocation. Recently, because of about 8 to 10% correction in the market, broader market, model has signaled increase in equity allocation from about 47% to 55%. So we are somewhere in middle at this point in time when it comes to equity allocation. Moving on to gold allocation, as I mentioned earlier, gold allocation in the portfolio is dependent upon relative performance of gold vis-a-vis equity. So if you look at gold to equity ratio, which looks at international gold prices convert back to in INR terms and then divide by Nifty TRI index, then you will get this particular chart. So this particular chart is also extremely cyclical. Half the time it is trading at expensive or on the upper end, half the time it is on the bottom half. If you look at gold to equity ratio, whenever market, the gold to equity ratio is below 2, which means that longer term basis, gold has underperformed vis-a-vis equity. Next 1 year, gold end up generating higher return of about 19%. On the contrary, whenever gold to equity ratio is above mean or significantly above mean, so let's say more than 3.5 times, next 1 year, on an average, gold returns are about 6%. So there's a clear trend here. One should be increasing gold allocation whenever gold to equity ratio is significantly below mean, and one should be looking to increase allocation towards gold whenever gold to equity ratio is significantly higher as compared to mean. So this particular slide shows model portfolio outcome. Whatever allocation suggested by the model, if we invest that particular money in the underlying index. So let's say if model is suggesting 55% equity allocation at this point in time, if I invest that money in Nifty TRI index, then what would have been what would be my outcome in next 1 2 year period? So only asset allocation side of the portfolio would have yielded broadly similar returns as compared to equity in an equity environment wherein returns are about 12 to 15%. So in a moderate equity environment wherein returns are 12 to 15%, model portfolio is generating similar return. But beauty of this particular approach is volatility of the portfolio is significantly lower than equity, because we are combining 3 asset class which are having low to negative correlation to each other, and because of this this diversification benefit, overall portfolio volatility is much lesser as compared to equity. That's what multi-asset allocation category offers, that on risk-adjusted basis, returns are far superior as compared to equity. Although in a very bull market environment, returns could be lower than equity, but in a moderate kind of environment, the fund could generate similar returns, but with far lesser volatility. Third part is the stock selection approach. And I would say this is extremely unique for UTI multi-asset allocation fund. So we have developed an approach called integrated investing approach, wherein we combine fundamental research with market signal. So we have 14-member research team which tracks about 400 companies, and they do extensive research on these 400 companies, which are across length and breadth of market cap as well as across sectors. And then we combine this research with market signal, and by market signal I mean various factors which performs well in different macroeconomic regime. Ajay alluded that between quality and growth, the styles keep shifting every 2 to 3 year period. So model will signal higher allocation to a factor which has significantly underperformed as compared to another factor. So we combine these factors, be it momentum, low vol, quality, growth, value, or across market capitalization as well. So that's the broad approach that we follow when it comes to equity side of the portfolio. Fixed income, we have adopted a very conservative and balanced approach here. So we focus on quality and liquidity when it comes to portfolio construction, because we believe that in asset allocation fund, it is very important that underlying portfolio is liquid, because whenever model is signaling increase in gold allocation or equity allocation, we should be able to take out money from fixed income without any impact cost. So that's why we have adopted this particular approach, wherein we are primarily investing in AAA and GSEC kind of papers with a modified duration of about 3 to 7 year horizon. And then in terms of factor, we keep combining allocation across these factors. So let me show you some trends of these factor indices which are present for almost 2 decades in India. So when we look at performance of these factor indices, then we will find that these factor indices are doing much better job in terms of longer term returns. So broad market cap based index Nifty 200 index has delivered close to 15% CAGR return in last 20 years without 20% volatility. All these factor indices have delivered much better outcome as compared to broader market, delivering close to 3% to almost 6% alpha on annualized basis in last 2 decades. Among these, momentum is one of the most consistent and best performing factor indices, delivering close to 21% CAGR return in last 2 decades, followed by low vol and quality, which have delivered close to 19% return. Each and every factor indices have different risk profile as well. Among these, low volatility index is having lowest volatility of about 15.8%, while value factor, which is extremely cyclical factor and rally factor, is having 25% volatility. So each and every factor index has different returns as well as volatility profile. So we combine these factors depending upon macroeconomic environment. As I mentioned that in last 3-4 years, value style has significantly outperformed quality, and because of which our approach is having higher allocation towards quality as well as low vol along with momentum. So in a trending market, typically we have higher allocation towards momentum. So let's say about a year back, we were heavily relying on momentum, but because of shift from value to quality that we have witnessed in recent past, we started adding allocation towards low volatility as well as quality style in last 6 to 12 month period in this particular strategy. If you look at yearly outcome of these factor indices, then we will find that different year, different factor perform well. So the winners keep rotating every year. Last 4 years or so, value was performing the best, but in the current financial year, quality has started doing much better as compared to value. Value, as I mentioned earlier, is extremely cyclical factor. About 4-year period, it ends up being a winner. And then in subsequent 3-4 year period, it ends up being a loser. So prior to COVID, value was one of the weakest performer for 3-4 year period. But post COVID, because of very strong macroeconomic recovery, value style starts performing much better as compared to any other factor indices. When we look at consistency of performance of these factor indices, then we will find that momentum is one of the most consistent factor, because in last 2 decades, 5 times it is the best performing factor, 5 times it is the second best performing factor, and 6 times it is the third best performing factor, while only 2 times it is the worst and second worst performing factor. So it is one of the most consistent factor, and that's why momentum is one of the core part of our portfolio. And whenever styles keep rotating, at that time we keep allocating money across other factors as well. At this point in time, momentum is the largest factor, followed by low volatility and then quality in the particular portfolio. I'll skip some of the slide in the interest of time. When it comes to asset allocation, as I mentioned earlier, we keep changing allocation across equity, fixed income, and gold. So in last 12 months or so, equity allocation is varying between 45 and 55%. Currently, it is 55% net equity allocation. During COVID, allocation towards equity was high because valuations have fallen drastically. So it keeps changing allocation across these 3 buckets. Beginning of the financial year, allocation towards gold was higher, the upper end of 20-25%. But because of very strong rally in the gold prices in last 1 year or so, gold has become slightly more expensive as compared to equity in terms of longer term trends. So that's why allocation towards gold has reduced to about 12% now as compared to 20-21% about a year back. Similarly, allocation across market capitalization also keep changing in this particular portfolio. When we started adopting this approach about 2.5 years, we were having 50% allocation towards large cap and remaining 50% towards mid and small cap. But in last 1 year or so, we started increasing allocation towards large cap, and currently it's about 80% large cap and remaining 20% towards mid cap, because on relative valuations, mid and small caps are trading at extremely expensive valuation as compared to large cap, and because of which allocation towards large cap has gone up while allocation towards mid and small cap has reduced in last 12 to 18 month period in this particular strategy. And this particular approach of combining factors, be it momentum, low vol, quality, and value, has helped us generate steady returns in last 2.5 years, ever since we started adopting this particular approach in this particular portfolio. So we started adopting this approach of integrated investing approach, wherein we combine business fundamentals, which along with these factor indices from 1st April 2022 onwards. So we have close to 3 years history of following this particular approach, and then outcome is favorable in this particular period, wherein fund has generated close to 20% CAGR return as compared to 14% for benchmark. At the same time, volatility of the portfolio is much lesser as compared to benchmark. And in the sense, as compared to equity as well as fixed income and gold, as compared to that also, fund has generated slightly better outcome in last 2.5 year period. So I will stop here and take any questions or feedback that you may have. Thank you.
Thank you, Sharman. Thank you so much for this wonderful presentation. And I'm sure all must have received their takeaways. So I have received few of the questions related to this theme only. So very well highlighted. And my first question to you is about how does the UTI multi-asset fund decide on the allocation between equity, debt, and gold? Are there predefined triggers or market conditions that drive challenges in the allocation?
Sure. So when it comes to allocation across equity, fixed income, and gold, we have developed a proprietary financial model, which is suggesting allocation across these three asset classes. As I mentioned earlier, we have developed a four-factor model, which looks at four relative as well as absolute valuation parameters, which are 1 year forward P ratio, price to book value, dividend yield, along with relative valuation approach, which is yield gap, which is equity yield minus bond yield, which looks at relative attractiveness of equity. So basis these factors, we have developed a proprietary financial model. And typically, whenever valuations are attractive, model will signal higher equity allocation and vice versa. As I mentioned earlier, in last 1 year or so, allocation towards equity is on the lower end of the spectrum as compared to 2.5 years back, wherein during COVID, market were trading at attractive valuation. At that time, model signaled higher equity allocation. So allocation across these three asset classes keep changing. Allocation towards gold is dependent upon relative performance of equity vis-a-vis gold from longer term trend perspective. And as I mentioned earlier, about a year back, allocation towards gold were higher because at that time, international gold price were hovering around $2,000. But because of very sharp rally of about 30% in gold in last 1 year, allocation towards gold has reduced in this particular year to about 11-12% kind of range. So allocation dependent upon longer term trend and following underlying financial model.
Yeah, thank you for the brief answer. Moving to my next question, does the fund follow a dynamic rebalancing strategy, and how frequently is the portfolio rebalanced?
Sure. So idea for changing allocation across these three buckets is to have slightly medium term perspective. Typically, the backtesting results suggest that 3 to 4 times trigger in a year, wherein every time we are changing allocation across, we are changing allocation by minimum 7% in the equity. So idea is to have certain buffer, otherwise impact cost of rebalancing would be higher. So looking at longer term trend perspective, we are getting triggers every 2 to 3 month period, and every time changing equity allocation by around 7% or so.
Okay. Thank you so much once again. Moving to my last question, could you highlight the key factors that have contributed to the fund's performance over the past years?
Sure. We have seen that different factors perform very differently in different macroeconomic as well as market cycles. And in this particular strategy, we are trying to identify medium-term trends in the category, and dependent upon we keep changing allocation across factors. So we were able to identify the trends correctly in last 2.5 years, ever since we started implementing this strategy in the particular portfolio. And so, and as Ajay have also shown that the outcomes across factors is extremely strong, or it could deviate by a big margin. Let's say a few months back, value was outperforming quality by almost 50%, which is almost 2.5 times as compared to broader market, right? So unlike traditional way of constructing index, which looks at sector allocation across different sectors, we are constructing portfolio based on different factors. And this particular approach has helped us generate steady returns in last 2 to 3 year period.
Thank you. Thank you. So there's many questions we had. So yes, we are really fortunate to have three amazing experts on today's forum. And I'm sure all our partners and colleagues must have got a very good learning from today's session. Thank you once again, Vetri, Ajay, and Sharvan, for such insightful presentation and also spending time for today's evening. So definitely, and also I would like to extend my thank to Deepak and Chitrakshi for arranging and coordinating this event really well. You guys were a really great support to all of us. So looking forward for many such interactions in future. Thank you so much. Over to you, Anjaneya sir.
Thank you,
Thank
Disha.
you. Thank
Thanks
you so
for
much.
being the great host. Thanks, Shravan. I mean, once again, from our side, for coming on this forum. I'm sure our partners have gained from this side of the story because multi-asset is one part which is, it reminds us of those Hero Honda CD100 bike ad, which had a tagline, fill it, shut it, forget it. So multi-asset is something similar. Like, ideally people don't have to worry about which asset class or which category you have to be in. So this is one which should be part of every client's portfolio. It may be small, big, whatever, but it should be there in every client's portfolio, every investor's portfolio. That's the best thing. And you managing it, nothing better than that. And thanks for sharing very good insights into this space. Truly appreciate Shravan once again from our side.
Thank you. Thank you.
Uh,
Thank you so much.
so
Thank you,
nice.
Anjanya. Thank you, Disha, for conducting it so well. Thank you so much. And Anjanya has already said it. Both the funds which we have discussed on today's call, UTI Flexicap and UTI Multi-Asset Fund, are extremely good funds to invest in. The themes are good, times are good, future looks promising. So I would request all your partners to look at it for their clients' wealth creation. And as Anjanya said it, multi-asset fund is the best fund in terms of fill it, shut it, and forget it. Thank you so much, and
So
wish
nice.
you all a great weekend. Thank you.
Thank you,
Thank you.
Deepak.
Thank
Thanks
you.
once again.
Thank
So
you.
UTI Asset Management, the first fund house to start mutual fund journey in India, and pleasure having the powerful leadership from UTI Asset Management, both on fund management as well as on the business development. They're on the call. I'm sure our partners are listening to it and they have seen the kind of insight which has been shared. So let's build relationship on ground and let's build assets for our partners as well as their investors. All the very best. We conclude the conversation. Thanks now.
Yeah.
Thank you. Thank you,
Thank you,
everyone.
partners, for the patient listening. And with this, we conclude today's session. Thank you so much. Thanks.